If you had invested just $1,000 with Warren Buffett in the early days, you would have over $30 million sitting in your bank account today. So what made him different? Why did his strategy outperform millions of others chasing hot stocks and trends? Today, we're unpacking the 7 unshakable rules of Warren Buffett that made him a billionaire and how they can help you make millions of dollars if you follow and apply these same rules when investing. These rules don't just apply to investing only. They apply to life. It's about mindset, patience, and discipline. So stay with me, because the further you go in this video, the easier it becomes to understand how to invest like a genius and build massive wealth over time. Rule number 1, control your emotions. Most people think investing is about IQ, that the smartest analysts, the best algorithms, or the most advanced models win. But Warren Buffett says the opposite. Buffett's success isn't because he's smarter than everyone else. It's because he's emotionally disciplined. Most investors chase trends. When markets go up, they rush in. When markets crash, they panic. But Buffett stays calm. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." While others look in the rearview mirror, Buffett looks through the windshield at where the business is actually headed. This emotional discipline lets him buy when others are scared and profit when others regret. Let's rewind to 2008. The housing market crashes, Lehman Brothers collapses, the stock market nosedives. Most investors were running for the exits. Some even pulled out their life savings. What did Buffett do? He bought. He invested billions into companies like Goldman Sachs and Bank of America when fear was at its peak. Why? Because of this timeless truth. Be fearful when others are greedy. Be greedy when others are fearful. Buffett wasn't being reckless. He wasn't gambling. He was applying logic while everyone else was driven by fear. The average investor is ruled by 2 emotions. 1, greed when prices are rising, and 2, fear when prices are falling. That's why people chase crypto at the top and sell their retirement portfolios at the bottom. They act emotionally, not rationally. Buffett, however, sees those moments as opportunities. He doesn't look in the rearview mirror. He looks at the fundamentals. Buffett understands that every bubble pops and every crash recovers. He once said, "The stock market is a device for transferring money from the impatient to the patient." Think about that. The market isn't just about stocks. It's about psychology. Most people sell too soon, buy too late, get scared too quickly, and that's why they lose. When Buffett buys a company, he doesn't check the price every day. He's not glued to CNBC. He doesn't care if it goes down 20% next month, because he knows what he owns, he understands the business, and he trusts time more than timing. He once joked, "If they closed the stock market for 10 years, I'd still be fine with my investments." That's emotional mastery. He doesn't panic when others do. He ignores the hype and stays calm, making decisions based on logic, not the news or what everyone else is doing. So what can you do? Ignore the noise. Turn off the 24/7 financial news. Focus on long-term fundamentals, not short-term headlines. Have a plan and stick to it. Know what you're buying, why you're buying it, and under what conditions you'll sell, if ever. Expect volatility and embrace it. Price drops are not a threat, they're a gift. They let you buy great businesses at discounts. Track your behavior, not just your portfolio. Keep a journal of why you made each investment. Look back and learn from your own psychology. At the end of the day, markets are emotional, but your success depends on staying rational. Buffett is not trying to predict the future, he's trying to survive the storms. Because in investing, the calmest sailor usually wins the race. Rule number 2, buy businesses, not stocks. Warren Buffett once said, "I am a better investor because I am a businessman, and a better businessman because I am an investor." That sentence explains a powerful mental shift. That secret separates Warren Buffett from 99% of other investors. He doesn't see a stock as a lottery ticket. He sees it as a slice of a real, living, breathing business. Most investors look at the ticker symbol, they look at the graph, and they ask, "Will it go up this week?" Warren Buffett thinks differently. He asks, "If I could buy the whole company, would I want to own it?" In other words, he doesn't just see a stock. He sees a real business behind it. Let me give you a real example. In the late 80s, Buffett made one of the best decisions of his career. He bought over $1 billion worth of Coca-Cola stock. Not because it was undervalued on a chart, not because of technical indicators, but because he believed in the company as a business. He knew people would still be drinking Coke 20, 30, 50 years later. He knew the brand was trusted, the distribution was global, and the margins were solid. He wasn't betting on a price swing. He was investing in human behavior and long-term earnings. If Coke raised its price by 1 cent globally, it would add millions in profit without changing anything about operations. That's not speculation. That's business economics. Buffett doesn't care what a stock does next week. He cares what the business earns in the next 10 years. In his early years, Buffett would buy cheap, failing companies, what he called cigar butts, companies that had maybe one last puff of value left in them. He made money doing that, but eventually he realized there was a better way. He once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." A fair company is like an old store that's losing customers. It might be cheap to buy, but it won't grow much. A wonderful company like Apple or Coca-Cola might cost more, but it compounds value over time. That's what Buffett wants. Businesses that generate cash and reinvest it wisely. Most investors are distracted by noise like stock forms, Reddit hype, CNBC headlines, and chart patterns. Buffett ignores all of that. Instead, he reads annual reports, listens to management, and studies the economics of the business. He once said, "The stock market is there to serve you, not to instruct you." If Coca-Cola drops in price, he doesn't panic. He gets excited because the business didn't change, just the mood of the crowd did. So here's the takeaway. Don't buy stocks, buy businesses. Every time you hit buy on a stock app, ask yourself, would I want to own 100% of this company? Do I understand what they do, how they make money, and how they'll grow? And am I buying something real or just gambling? Warren Buffett didn't get rich flipping stocks. He got rich owning great businesses for a very long time. Rule number 3, stay within your circle of competence. One of Warren Buffett's most underrated rules, and yet perhaps one of the most powerful, is this. Know your circle of competence and stay within it. What does that mean? It means only invest in businesses you truly understand. Not just what they sell, but how they make money, their cost structure, what could destroy them, and what could make them thrive. Buffett says, you don't need to be an expert on everything, but you need to be an expert on what you invest in. Find your circle. Stick to it. Your biggest mistakes won't come from what you didn't know, but from what you thought you knew and were wrong about. During the dot-com boom in the late 1990s, investors went wild. They invested in companies that had no products or profits, just a website and big promises. Everyone laughed at Warren Buffett. They said he was old-fashioned and missing out. Why won't he invest in tech, they asked. But Buffett was honest. He said, I don't understand it well enough to know how much money it will make in the future. He didn't pretend to know everything. He didn't try to follow the crowd. And guess what? When the bubble popped and those tech stocks crashed, Buffett didn't lose a dime while many others lost millions. Buffett's circle is surprisingly small. He doesn't invest in crypto. He doesn't buy NFTs. He avoided internet companies for decades until he found one he could understand. Apple. Not because of the tech, but because of its branding, customer loyalty, and cash flow. Buffett understood Apple's business, not its code. He once said, it's not how big your circle of competence is that matters, it's how well you stay inside it. Warren Buffett only invests in things he truly understands. He calls this his circle of competence. Here's how you can find yours in 2 simple steps. 1, learn how the business makes money. Don't worry about the stock price. Ask yourself, can I guess how this business might be doing 10 years from now? Will people still want their products or services? Buffett says, if I cannot understand how a company will make money in the future, I don't invest. 2, be completely honest with yourself. This is the most important part. Most people think they know more than they really do, and that gets them into trouble. Buffett's secret? He admits when he doesn't understand something. He's not afraid to say, I don't get it, so I'll pass. That's why he avoided tech stocks during the dot-com bubble. And when it all crashed, he didn't lose money because he never invested in what he didn't understand. Stick to what you know, learn what you don't, and don't pretend to understand something just to sound smart. In investing, saying, I don't know, can actually make you richer. So before you invest in anything, ask yourself, do I understand how this company makes money? Can I explain it to a 12-year-old in 1 sentence? What are the biggest risks to its future earnings? Am I buying because I understand it or because it's trending? If your answer is I'm not sure, that's a sign. Walk away. There will always be another opportunity inside your circle. Rule number 4, think in decades, not days. Most people approach investing with a microwave mindset. They want results now, today, maybe even this week. But Warren Buffett plays a different game. He invests like a farmer. He plants seeds, strong businesses, and then he waits. He waits through seasons of drought, storms, and even market crashes. Because he knows wealth doesn't appear in the short term, it compounds quietly in the background. He once said, "Our favorite holding period is forever," and he means it. Take Coca-Cola, one of Buffett's most iconic investments. He started buying shares in 1988 when the market was still reeling from the crash of '87. People thought he was crazy. Why put billions into a soda company? But here's what Buffett saw: a brand loved by billions, a global distribution network. Consistent consumer habits were unlikely to change. So he bought it and held it for decades, no matter what the market did. While others jumped in and out of tech bubbles or panicked during 2008, Buffett just sipped his cherry Coke and stayed the course. And guess what? That one investment paid Berkshire Hathaway over $700 million in annual dividends, not counting stock price growth. Let's say you're 25 and start investing $500 a month. That's $6,000 a year. In 30 years, at 10% returns, you'd have over $1 million. Not because you're chasing meme stocks or timing the market, but because you trusted the process and stayed the course. Buffett calls this the snowball effect. Once the snowball gets rolling and you keep adding to it, the momentum becomes unstoppable. But you've got to give it the hill, and that hill is time. Rule number 5, the power of integrity. When Warren Buffett hires people or chooses who to trust with his money, he looks for 3 things: intelligence, energy, and integrity. But here's the kicker. Without integrity, the first 2 will destroy you. A smart, energetic person without ethics is dangerous. Warren Buffett once said, "If you're going to hire someone without integrity, you better hope they're dumb and lazy." Buffett understands that investing isn't just about numbers. It's about human behavior. The same principle applies when picking stocks. The integrity of a company's leadership, their long-term mindset, their honesty with shareholders matters more than quarterly profits. Take See's Candies, for example. When Buffett bought it in the early 1970s, it wasn't because it was a big tech company or a fast-growing new business. He bought it because of the people running it. People he believed would treat customers, employees, and shareholders with honesty and long-term respect. See's Candies turned out to be one of Warren Buffett's best investments. But why? Because the people running it were honest and trustworthy. So how can you use this rule in your own life? Whether you are hiring someone, investing, starting a business, or choosing friends, ask yourself, would I trust this person if no one else were watching? Buffett understands something most people forget. Character grows over time, just like money. Someone who does the right thing, even when it's hard, will do better in the long run than someone who cheats just to win today. And this isn't just about others. It's about you too. Before asking who you can trust, ask yourself, would Warren Buffett trust me with his money? It's better to be honest than clever, and better to be steady than flashy. Rule number 6, avoid mistakes of omission. Buffett doesn't just learn from his successes. He learns from the things he didn't do. One of his biggest regrets wasn't a bad investment, but a missed one. There was a time he could have bought Fannie Mae at a super low price. He knew the company well, understood how it worked, and saw it was a good deal. But he waited. He hesitated, and because of that, he missed the chance, a decision that cost his company billions of dollars. Buffett calls these thumb-sucking moments. Most of your regrets in life won't come from the risks you took. They'll come from the opportunities you didn't take. So here's the lesson. If you know it's the right move, don't wait. Big chances don't come often. When they do, grab them. Rule number 7, invest with purpose, not hype. In today's world, information spreads fast, and hype spreads even faster. Reddit, TikTok, Discord, and news headlines, they all telling you what the next big stock is. But Buffett, he is not listening. He is not interested in what's hot. He is interested in what's real. Let's be honest, most people aren't investing. They're just gambling. They buy something because it's trending, and they don't understand the business, the financials, or the risks. Buffett says, risk comes from not knowing what you're doing. When he buys a company, he asks, how much money will this business generate? When will it generate it? And how certain is that outcome? That's called intrinsic value. Think of intrinsic value like this. Imagine you buy a fruit tree. You're not buying the tree for how pretty it looks today. You're buying it for the apples it will give you over the next 20 years. The more apples it produces and the more confident you are in that outcome, the more the tree is worth. Stocks are the same. A company is only worth the cash it will generate over its lifetime, discounted back to today. So Buffett doesn't ask, is the price going up next week? He asks, how much value will this business create in the next 10, 20 years? If it's priced below that value, he buys. If it's above, he walks away. While everyone else is busy trying to get rich quickly, Buffett plays a different game. He buys predictable businesses with strong cash flows, which is run by honest managers at a fair or better price. No hype, no drama, just logic. Because hype fades, emotions fluctuate, but value is measurable. Buffett once said, you should never invest in a business you cannot understand. If you can't explain why you're buying a stock in one sentence, you're probably just speculating.